Good morning, and welcome to today's webcast, Tax Strategies and Economic Recovery for Healthcare Organizations. We'll be saving time at the end of the webcast to answer your questions. To ask our presenters a question, please type it in the Q&A window and hit submit. If we don't have time to answer your question, we'll be following up with you after the webcast. Although today's webcast is not eligible for CPE credit, we encourage you to participate in our polling questions throughout the presentation. Finally, in addition to today's presentation, Moss Adams has many other resources to help you navigate COVID-19, including a webpage dedicated to healthcare. You can find links to these resources in the slide deck and handouts widget to the left of the slide view. And I'm pleased to introduce today's presenters from Moss Adams. Chris Bell, Partner and National Practice Leader for Medical Groups and Physicians, and Rob Grannum, Partner and Regional Industry Group Leader. And with that, I will turn it over to Chris to get us started.
Thank you, Emily, and welcome to everybody joining us today. The world has been full of changes over the past number of weeks. In today's agenda, we want to cover a number of items. It's an aggressive agenda. So we'll cover all these items and as many questions as we can get to. We're going to spend a brief amount of time on the Families First Coronavirus Response Act. We're going to cover the Coronavirus Aid, Relief, and Economic Security Act, the CARES Act, both the loan programs and specific tax provisions. We want to talk about planning opportunities that many of our clients and our partners have been discussing, and we believe organizations should have top of mind. And then we'll have time for questions and answers after that. And with that, Emily, it looks like we have our first polling question.
All right, our first question, what is the primary nature of your organization? And your options are A, physician or dentist, B, health plan, C, hospital or health system, D, surgery center, E, long-term care, or F, other. And I'll give everyone a few moments to respond. To participate in our polls today, please click the button next to the answer you choose and hit submit. And if for some reason the polling question is not coming up on your screen, you may try refreshing your browser, and that should reset the question. And I'll give everyone a couple more seconds. And let's go ahead and take a look at the results. Chris, back to you.
All right, thank you. We have quite a mix of people on the line, which is fantastic to see. And I'm going to turn this section over to Rob to cover the Families First Coronavirus Response Act.
Perfect. Thanks, Chris. Hello, everyone. This was one of the first acts of Congress as it relates to COVID-19. It's the Families First Coronavirus Response Act. It was passed on March 18th, just a couple weeks ago, and it's effective April 1st through the end of this year. And basically what this act does is it effectively requires employers, those employers with less than 500 employees, to provide paid leave under two separate provisions. The Emergency Paid Sick Leave Act and the Emergency Family and Medical Leave Act, which is an expansion of FMLA. And it reimburses these employers for the amount of compensation and benefits for providing these benefits dollar for dollar through payroll tax credits that they'll receive immediately and in the future. What's important here is that one, this is very technical. We are encouraging clients to work with employment law attorneys for any guidance on this. In the Department of Labor is the enforcement agency for these provisions, and they've got a lot of great information on their webpage with regards to how this works. But effectively, for the paid sick, which provides for up to 2 weeks or 80 hours of compensation, if an employee is is quarantined or sick seeking a COVID diagnosis, it provides for a full rate of reimbursement for up to 2 weeks at the higher of the employee's current wage or minimum wage, which is considered $511 per day for a total of $5,100 total for that period. If an employee is caring for someone that's in quarantine or caring for a child under the age of 18 whose school or child care provider is closed due to COVID, it provides for paying at 2/3 of the employee's rate, the higher of 2/3 of their actual rate, or $200 a day. An employee is also provided for 2/3 of their wage base to the extent that they're experiencing symptoms that are substantially similar to COVID diagnosis. So that's the paid sick. If an employee is experiencing one of those situations, the employer is required to provide them up to 2 weeks of compensation. To the extent that there's also the paid, the Emergency Family Leave Act, which provides for an additional 10 weeks at 2/3 of their normal rate, where the employee is not able to work, and that includes not able to telework, where the employee is caring for a child whose school or child provider is closed due to the COVID situation. Employees must have worked at least the prior 30 days. This would be a pretty common situation. We've got obviously a lot of schools canceled right now, and so a number of folks may fall into this camp. So it effectively would provide up to 12 weeks of total pay. Now, to reimburse the employers for this pay, the employer is allowed a credit up to the amount that they pay for the wage and health benefits and so forth. It's fully loaded, and it's used as an immediate tax credit. So effectively, you don't pay employment taxes, employee federal income tax withholding, and so forth, up to the amount that you're paying in the wages. To the extent that the wages exceed what your employment taxes would be currently, there is an immediate refundable credit opportunity, and the IRS just released Form 7200, I believe yesterday, which provides for mechanical provisions for receiving a refund immediately on those amounts. And so again, this is it's a pretty technical provision, and I would encourage you to speak with an employment law or attorneys or even your benefits broker. Finally, there's a provision for employers less than 50, some exemptions for this if the leave would jeopardize the viability, the going concern of the business. So I think there's more clarity that is coming out on that particular provision. But if you're under 50, there may be an exemption. And I think we were at our next polling question.
All right. Our next polling question: which financing program is your organization most interested in learning about? And your options are SBA disaster relief loans, B, SBA payroll protection program loans, C, Federal Reserve loans to mid-sized businesses, D, CMS advanced and accelerated payments program, or E, other programs. And I'll give everyone a few moments to make a selection. And let's go ahead and take a look at the results. Rob, back to you.
Great, thank you. One second, I lost my live view. There we go. So it looks like most folks are definitely interested in the payroll protection program loan, and I'm not surprised. That's what we're hearing every day this week and last week from clients, and so we'll definitely jump into that a bit. And also a lot of interest in hearing about CMS's advanced payment programs. So, and we'll touch on that as well. With that, I will hand it over to Chris.
Thank you, Rob. With the when we originally put together the material, we started putting it together before the CARES Act was passed, and since the Act has passed, it's taken over the majority of our slide deck. There's a lot of components. So with the CARES Act, we want to focus on the various grant and loan programs. We're going to cover the Public Health and Social Services Emergency Fund, the Federal Reserve loans, Small Business and Administration loans, and then we're going to get into tax credits and other changes that are enacted as part of the CARES Act. So the first part of the Act that isn't widely reported, I think because it is healthcare specific, is that a $130 billion fund was created to support various healthcare organizations. Hospitals will be a big recipient, but also medical groups, physicians, and other providers who are seeing reduction in their productivity in order to make room in the healthcare system to treat the COVID cases, and who are seeing disruption in their businesses. So while it's talked about as a single fund, it's actually a variety of grants that are being administered by a number of different agencies. So application details are still being released. There's a wonderful article that lists out, this article by Carl Rebe and Georgia Green, listing out the various programs and how to apply, and we have a link to that article here. Many of the programs applications aren't yet available, can't apply for yet, but they're coming online quickly. The Act was passed on Friday, and the first application deadline was Monday. It was for state hospital associations, so they had until Monday to apply for a $50 million grant. So this is an area that's being updated regularly. As part of that, CMS announced its Medicare Accelerated and Advanced Payment Program. This is not a new concept. CMS has done similar things for disaster areas in the past, but it's being applied broadly here. So the qualifications: you have to have filed a Medicare claim within the last 180 days. You may not be in bankruptcy. You can't be under active medical review, a program integrity review, anything, including anything from a TPE or RAC audit. Delinquent overpayments, including any that you feel are wrong but are accused of owing. So you can't be in any of those categories. Most Part A and Part B providers and suppliers can request up to 100% of the Medicare payment amounts for a 3-month period, and they'll have 210 days to repay the balance. The intention here is to get the funds out quickly, so there's a promise that the cash will come out to providers within days. The challenging area is going to be on the reconciliation end, and that's what we're hearing from some of our consultants who worked with a similar program after Hurricane Katrina hit, is that when it comes to reconciling the repayments with Medicare, because they may be withholding funds from payments you would otherwise receive, that can create a little bit of a challenge. For inpatient and acute care hospitals, children's hospitals, and certain cancer hospitals, you can request 100% of the Medicare payment for a 6-month period, and you'll have 1 year to repay the balance. And critical access hospitals can request 125% of the Medicare payment amount for a 6-month period, and will have 1 year to repay the balance. This has been an area of high interest, in part because it can get the cash out to providers very quickly. Medicare sequestration, the 2% Medicare sequestration withhold has been suspended from May 1st through the end of 2020. And Rob is going to cover the SBA or small business loans for organizations that have more than 500 employees and who don't qualify for small business administration loans. There's a $500 billion fund. Some of it has already been carved out for specific industries, but $454 billion is a general fund that's available for any mid-sized businesses to apply for. Mid-sized business is defined as between 500 and 10,000. The loans are at 2% interest rates. There's a 6-month deferral before the first payment is due. But there are a number of conditions and restrictions on borrowers. These loans are backed by the Federal Reserve and managed by the Treasury Department. The application and how these loans are going to work has not been released yet. We're checking the Department of Treasury site every day to see when that will be announced. Here are the conditions to these loans. The loans must be necessary to continue operations as a result of the pandemic. You have to maintain employment levels at least at 90% of where they had been at the start of February of this year. That employment level, that 90% employment level or better, must be maintained through September 30th. It's for U.S. businesses only. The business cannot be in bankruptcy. You have to commit to not outsource or offshore jobs during the duration of the loan plus an additional 2 years. So depending on how long it takes to repay the loan or how quickly you repay the loan, that could be a long commitment. There are additional rules for employers with union workforces, and there are restrictions on dividend payments, stock repurchase payments, and executive compensation increases. So this is something that organizations should be very thoughtful about before entering. In particular, if you're considering selling your organization, whether to a private equity fund, venture capital group, or some other institutional investor, at some point in the next few years, you might take a real close look at this loan and see if any of the conditions would make it difficult to accomplish that sale. And with that, I'm going to turn it over to Rob to talk about the very popular SBA loans.
Great, thanks, Chris. This is one of the loan programs that we're seeing a lot of interest in. It's the kind of the traditional small business loan program. It's called the Economic Injury Disaster Relief Loan. Guidance was issued March 12th, just a few weeks ago, on this particular program. And effectively, it's for small businesses, which in the healthcare space, this is different than the payroll protection program that we'll talk about on the next slide, in that it's based on traditional North American Industry Classification System code system. And so in the healthcare space, it's going to be based on your annual revenue. And for healthcare providers, that is a very broad from a NICS coding standpoint. It's a range of about $7.5 million in revenue to $38 million in revenue. So it's important that you look at those NICS codes to see where you fall and if you qualify on the surface for this type of program. But it provides up to $2 million of loan assistance for operating expenses and actual economic injury needs. Interest rates of 3.75%. The term's not to exceed 30 years, but certainly depends on your ability to repay. There is a 1-year deferral of payment, but the interest will accrue. And it's only available to businesses where the SBA determines they're unable to obtain credit anywhere else. The online, we gave a link here to the online application, and it is an online application. We are hearing, for those of you that have applied, you're probably experiencing long delays. We've seen in the last week a lot of website crashes on SBA's website. Unfortunately, there's just a lot of demand for this program, and so expect delays for sure. But it is a great program. Application deadline is December 16th of 2020. Now, the Payroll Protection Program, which is another SBA sponsored loan program, it's basically an expansion of the traditional SBA 7A program, is very popular right now. I think many folks on the phone, obviously 50% of you were interested in this particular program. What I will say in talking with bankers in the last few days, a couple things before we get into the details is a lot of these details, one, have changed and will continue to change. The law was was just passed in the CARES Act a week ago, and not even a week ago, and there's still a lot of guidance that's still coming out from SBA and Treasury. But effectively, there's roughly 30 million small businesses that are eligible for this that are considered under 500, and they anticipate really only about a 1/3 of those that apply to actually get in. There's just such high demand for this particular program. I heard yesterday that there's 12 years worth of SBA loans crammed into about a month period here. So it's very unprecedented. The good news is it is running through the lenders, through commercial banks, and so that's helping the process. The best practice here is if you've got an existing banking relationship, you should be talking to them for sure and get in line and get your loan application processed. So I'm going to go through the details here. Like I mentioned, it's accessed through a qualified SBA lender, which is a lot of banks. And I know that the big banks, the big nationals, are setting up processing centers behind the scenes to process all these loans. There's no application fees, closing costs, no collateral or personal guarantees. The application process is actually pretty straightforward. And the American Institute of Certified Public Accountants, the AICPA, on their website, they just launched a calculator to help figure out the maximum loan amounts. That's kind of where the sticking point is right now, is folks are trying to figure out how to calculate the loan amounts. But the bank is, the commercial banks are 100% guaranteed by the SBA. We have a bullet here that says the maximum interest rate of 4% and max term is 10 years. That was as of a couple days ago. And now we're seeing that the new rate is 0.5% at a 2-year term. So that's quite different than how it came out in the CARES Act bill last week. The first 6 months of payments are automatically deferred. And this is this is where it gets quite complicated, is the maximum loan amount is the lesser of 250% of your average monthly payroll, or $10 million. So 2.5 times an average monthly payroll for you is your max loan amount. It can't be used on costs where credit was received under the provisions we talked about at the beginning of the webcast with regards to paid sick and paid leave. Essentially, you can't double dip on the benefits. But in general, it's available to businesses that are not employing more than 500 employees. There are certain exceptions to that, largely in businesses that operate under a franchise model, hotels, food service, and so forth. It gets complicated, and there's a lot more guidance that's still needed with regards to affiliation rules. When you've got multiple entities that are affiliated and that puts you over the 500, there's still guidance coming out on that. The applicant must certify their own uncertainty of the current economic conditions for the loan and to be able to support ongoing operations. And there's a whole host of questions and so forth that you need to certify to. And the biggest piece is to ensure that you're going to use the funds to retain workers. And so the proceeds, the big deal on this, where they're putting $350 billion in this pool, and I think the big appealing piece of this payroll protection program obviously is the ease of entry into the loan, but also the forgiveness of the loan proceeds to the extent that it's used for payroll, rent, utilities, mortgage interests over an 8-week period from when you receive the loan proceeds. 8 weeks from there, you've got to use it on these particular functions. You also have to maintain your compensation levels for your employees of at least 75% of their previous levels. So that gets complicated as far as the calculations, but that's the spirit of the law, is to incentivize businesses to retain and hire employees and keep your full-time employee count up. Proceeds on that calculation, note that they are capped at $100,000 of payroll per person. Application process starts tomorrow, April 3rd, and you need to apply by June 30th. And so it's a pretty short window to get this application. Again, there's so much pent-up demand. They feel, everything I've heard is that the funds will be spoken for soon. Talking to bankers, not sure how they're going to do a kind of a first-come, first-serve process, but more to come on that. I would just really encourage folks to be talking with their lenders on how this is going to work and whether they can get in. I mentioned the application process. So in summary, for example, if you have $1 million monthly payroll, and that's your burn rate, your maximum loan on the surface would be $2.5 million. And it could be entirely forgiven if it's spent on these qualified activities over an 8-week period, and you have no reduction in force of your employment. So that is the big appeal to this program, and to the extent that you need more information, we've got a lot of content on our website, and then certainly most of the big banks have a lot of great information out there. So with that, I'm going to move us to our next polling question.
All right, our next question: what best describes your current operations? A, operating above normal capacity. B, operating at normal capacity. C, operating below normal capacity. Or D, operating significantly below normal capacity. And we'll give everyone a few moments to make a selection. And just a reminder that we will be sending out the presentation slides and recording via email sometime tomorrow morning. And a couple more seconds. And let's take a look at the results. Back to you.
Great. It looks like very few folks are operating at above normal capacity, and it's actually encouraging to see at least 30% of folks operating at normal capacity, but obviously, as we're all experiencing, 2/3 of folks are below capacity, with 30% at significantly below capacity. We're certainly seeing that in our client base. I'm going to hand it over to Chris.
Hey, Rob, before you get off the line, I just wanted to share some things that I'm hearing from bankers and see if you're hearing similar things. Some of the bankers that we've been talking to have been encouraging applicants, especially for this payroll protection program loan that has the forgiveness provision, to make sure that they're comfortable with the loan terms themselves. There are a lot of details around the forgiveness that just haven't been released yet. We know what the CARES Act said it should be, but how that's carried out, there's still some things that aren't known, and making sure that people are okay with the loan terms. At 2 years at 0.5% interest, it seems like a great deal to me, but organizations should be entering it like they would any other loan. Is that similar to conversations you're having with your clients, Rob? Absolutely.
I would not bank on the forgiveness component. I mean, if it happens, that's great. But I agree, Chris. I think 2 years is an incredibly short window, and the loan forgiveness component of it is not entirely baked out as far as how that works. You've got to apply for it, and so we're not entirely sure how it's going to work. So I totally agree, Chris.
Okay. Thank you, Rob.
Good point.
The CARES Act has a number of tax provisions in addition to these loan programs, but the intention of the tax provisions is to get cash flow into the hands of businesses as quickly as possible. So unlike the tax reform law that was passed in 2017, or some of the tax reform provisions that accompanied the Affordable Care Act that rolled out over a period of time, this is intended to get cash into the hands of individuals and businesses fairly quickly. The first one, and this is an important one to consider, is the employee retention credit. Rob may have mentioned, I know it's in the slides, but if you apply for the Payroll Protection Program loan and you receive that loan, you won't be able to take advantage of these next two credits or programs, the employee retention credit and the deferred payroll tax deposit program. So it's an either or. You have to determine which one is best for your organization and go that route. So with the employee retention credit, the way it works is you're allowed a credit equal to 50% of the wages on the first $10,000 you pay to each employee. So it works out to $5,000 per employee as long as they're earning $10,000 over that period. It applies to all employers, but employers who are going to get the most benefit are employers who meet one of two criteria. Number one, was their business fully or partially suspended during the calendar quarter due to orders from an appropriate government authority. I think in healthcare we're running into problems for this criteria because we're considered an essential business activity, and so many healthcare organizations are not going to meet this criteria. But the second criteria you might meet, which is if you can show that you had a significant decline in your gross receipts, which means your gross revenues, to where your revenues are less than 50% of where they had been in the same quarter the previous year, then you'll qualify for the higher level of this credit. And so the way that works is if you have more than 100 employees, or just a moment here, if you have more than 100 employees, the wages for the employees that are not working are the ones that get factored into the credit. So you have to look at employees who've been furloughed or who are working reduced hours, but you're still paying them their full salaries. Those wages are what qualify for the credit. So there's a differentiation between employers with over 100 employees and employers with fewer than 100 employees. If you have 100 employees or less, then wages for all your employees will qualify for the credit. And so that's going to be the helpful thing on that slide. This does not include any wages from the Families First Coronavirus Response Act. That's where there was paid leave because there's a separate payroll tax credit that's involved with that. And affiliated or control groups may apply to the 100 employee test, and that's an area of uncertainty. So if you have multiple businesses that are owned by the same ownership group, do you have to look at all the businesses together to determine whether you're over 100 or under 100? We don't know the answer to that yet. Rob, I'm going to turn this over on the delay in payment of employer payroll taxes to you.
Great, thanks, Chris. This one's pretty simple. It's also pretty valuable for employers. Effectively, simple as delaying your employer portion of your payroll taxes beginning March 27th through the end of this year. Deferring 50% of that would be due the following December 31st, 21, and the remaining 50% of that balance due December 31st, 22. The employer, as Chris mentioned, is not eligible for the deferral if you had debt forgiveness under the Payroll Protection Program. Again, it's one or the other. And so this is, again, a deferral of your employer portion, 6.2% Social Security taxes, and it is also eligible for self-employed individuals as well. Okay, Chris?
Before we get there, we've received a number of questions, and I wanted to highlight them here about whether you can apply for both the disaster recovery and the payroll protection program loans under the SBA program. Rob, I don't know if you have any thoughts on that. I know a number of clients are approaching it that way, where they are applying for both as long as they're not in the application. You have to say what the proceeds are going to be used for. You can't double dip. So it has to be covering different costs. How are you approaching that, Rob?
The same, yes.
Okay. I just wanted to highlight that because in the Q&A section, we're seeing a lot of questions around that. Advance the slide here. So under the Tax Cuts and Jobs Act of 2017, this is the Tax Reform Law of 2017, there were limitations on interest deductions. You could essentially deduct no more than 30% of your adjusted taxable income number in any given year. And so that threshold has been raised from 30% to 50%. When you conceptually think through this, it's helping organizations that have seen a reduction in their incomes, which is what most of organizations are seeing in 2020, and who are going out and getting loans and having interest payments related to those loans. More leveraged organizations. So this is very helpful to taxpayers to make sure that they're going to be able to deduct the interest on the loans they're taking out to bridge the gap over the next few months. Rob, do you want to cover the qualified improvement property?
Yeah, this is this is a nice technical correction that we saw that they put into this bill. With the tax reform bill at the end of 2017, largely effective for 2018, there was a drafting error in that legislation in that qualified improvement property, which is really improvements made, it's leasehold improvements effectively. It's improvements made by the taxpayer to the interior portion of what's called non-residential real property after the building was first in place. It doesn't include enlarging the building, putting in an elevator, escalator, or any kind of internal structural framework. So I would think of it as traditional tenant improvements in a space. And what the law did initially was treated that as 39-year property, not subject to the favorable 100% bonus depreciation provisions. And so what they did in this bill is they corrected that, and they said that qualified improvement property is indeed 15-year property and eligible for bonus depreciation. And it's a retroactive fix back to improvements that were placed into service in 18 as well as 19, but it went back to the beginning of January 1 of 2018. So we're really encouraging folks to look at, if you had any kind of improvements placed into service in 18 or 19, to take a look at your depreciation schedules. This is all for tax purposes, and make sure that you don't have any opportunity here, because it can be very lucrative, where you would basically be taking an asset, say you spent $200,000 on a particular build out, and instead of booking this at 39 years, you could treat it as 15-year and subject it to 100% bonus, effectively writing the entire thing off. And so the timing difference is very substantial here. And there are ways to, if you have some in 2018 and obviously you filed your return, there are ways to do a change in accounting method to make that effective for 2019 and not have to necessarily amend your 2018 filing. So this is a great one to take a look at to find some tax opportunity. Chris?
Thank you, Rob. Another change, again related to the tax reform law in 2017, was that it limited the ability for most organizations to take losses in a year and carry back. And so net operating losses that have been originated can now be carried back for 5 years. So this under the CARES Act. So this is a change, and that means if you paid taxes in the last 5 years as an organization, you can take losses generated in 2020, and you can carry those losses back and recover taxes you paid in previous years. You could also do the same thing with your 2019 return. You can carry, which are being prepared now, you could carry losses back. It also allows, net operating losses to fully offset, that are carrying forward to fully offset taxable income through the end of 2021. This was a provision that prevented companies from using net operating losses carrying forward from previous years to completely wipe out their taxable income. They could only wipe out up to 80% of their taxable income in any given year. And it also postpones the excess business loss rule for individuals through the end of 2021. That change is retroactive to 2018. So for a number of these items, there's an ability to make changes or to amend returns and to get some additional cash flow. Rob, do you want to cover the recovery rebate?
Yeah, so everyone's probably heard a lot about this in the stimulus bill, the $1,200 rebate to single taxpayers and $2,400 for joint, and then $500 for each qualifying child. This is a one-time refundable tax credit. Effectively, it's a cash payment to individuals. Those amounts phase out with individuals taxable income exceeding $75,000 and fully phased out at $99,000, and for married filing joint, that $2,400 is maxed out at $150,000 of taxable income, and then slowly phases out completely at $198,000 of taxable income. That was the crux of the law, and then since the law passed, the Treasury Department and the IRS have been providing further explanation as far as how this mechanically is going to work. How is the money going to get in people's hands? And for the most part, to the extent that you filed a 2018 1040, it will be based on your 2019 1040, and to the extent that you didn't file 2019 yet, then it would be based on 2018, and to the extent that you had direct deposit instructions on your 1040, the IRS will be providing direct deposits. To the extent that you don't have direct deposit information on your tax returns that you filed, the IRS is in the process of setting up what they call some kind of a portal where taxpayers could go in and input their direct deposit information. For folks that there's been a lot of chatter about, well, what if folks don't have to file income tax returns if you're, say you're a senior subject to Social Security, then what the thinking is right now is, to the extent that you're receiving Social Security benefits, the IRS has all that information and they'll be paying recipients that way. And to the extent that you don't fall into any of those buckets, the IRS is working on ways to make this work. There was talk about filing a kind of a blank tax return, so to speak, just to get the information in. I think that's still in the works. So more to come on that. The good news is I think a lot of this money will be moving pretty quickly to the extent that you filed an 18 or 19 tax return. Chris, anything to add there? I think the other thing that's maybe up in the air is the reconciliation based on your income if you hadn't filed 19 yet.
The only thing I would add there, Rob, is I think it highlights one of the biggest challenges with the CARES Act is not necessarily the government finding ways to finance and get this money into the system. It's how can it get the money quickly into the system, even how to do direct deposits, make sure all the checks are going to correct and updated addresses, things like that, and getting it out quickly. It takes a lot of time, a lot of energy, and we have people who are working around the clock to try to make that happen on the government end. And in terms of, just as a comparison, when the Tax Cuts and Jobs Act was passed in December of 2017, some of the regulations that impacted health care, like the 199A regs, were not released until a full year later. But we're seeing initial guidance coming out within days of this act passing, which, given the size of the program, I think shows a lot of focus.
Thanks, Chris. I think you're covering retirement plan changes.
Absolutely. So I think this is helpful, particularly for small businesses with owners who have money set aside into 401k plans and have IRAs and other retirement plans. You can take distributions up to $100,000 without having the 10% penalty on early withdrawal. As a reminder, if you withdraw funds early from your retirement plans before you reach a certain age, then you're going to be subject to a 10% early withdrawal penalty. So it waives the 10% penalty, and eligible distributions can be repaid to the plan within 3 years, and income from the distribution can be recognized over a 3-year period. So it's very generous to help taxpayers who have initial short-term cash flow needs to essentially borrow some funds from their retirement plan and pay it back quickly. It also waives any required minimum distribution rules for 2020. So under the previous rules, once you reached age 70 and 1/2, if you had retirement accounts that were not Roth IRAs, so any traditional IRA retirement accounts, you had to take minimum distributions every year. There was a law change earlier this year that moved that from age 70 and 1/2 to age 72, but that has been changed. So there's no required minimum distribution rules for this year.
Okay, so now we're going to, Chris?
Go ahead, Rob.
Oh, I was just going to state what we want to do now is just, we had a few other thoughts with regards to other things to think about from a tax perspective. We'll get into some other things to think about from a business perspective, and then we will also try to get to some questions. I know there's been a number of questions logged, and we've been trying to answer a few of them along the way. But just from a tax perspective, one of the bullet points that's not on here that folks are probably well aware of is the federal government has provided a 90-day deferral of the filing, an extension effectively of the April 15th filing deadline to July 15th. And that also includes, initially it didn't include payment as well, but tax liabilities are also deferred 90 days to July 15th. So really good news, especially if you're a tax practitioner, but more importantly for taxpayers, gives you some breathing room to, and we're certainly using it to absorb the CARES Act and apply it to our clients and make sure there aren't any planning opportunities we want to take into play and into consideration before we file. The other thing is there's the states are daily coming up with their own extension provisions and other types of relief provisions. In this presentation, we didn't get into really any state tax implications, but there's quite a bit, and it's certainly all over the board depending on what state you're in. In the state of Washington, for instance, there's a 60-day deferral of taxes with the Department of Revenue. We've got an alert on that on our website, but that's that can be a very meaningful deferral for a lot of taxpayers. Oregon, for instance, also extended their income tax deadline to be in line with the federal government. Chris, any other comments with regards to states?
No. The only other comment I would share is that it's changing regularly, and you need to look carefully at each state. Some of the states have been deferring payment and filing requirements for individuals and some partnerships, but corporations don't always have their due dates and payment due dates extended in some of the states. So you have to look at each state very carefully, and it's changing weekly. So I know we're reaching out and checking in the states where our clients operate. We're checking on a daily basis to see what updates, not just to income taxes, but sales taxes, payroll tax deposits. There's a variety of taxes organizations may be paying.
So with regards to just some other planning matters, obviously valuations are at a lower point. Certainly, if you've been tracking, which I'm sure we all have been tracking, what's happening in the equities market and the stock market, valuations are definitely at a low point. And that in turn, the economic performance of businesses has not been great and won't be great. Certainly in the second quarter, that all impacts valuations. And when you have low valuations, there's opportunities to do a number of different things. And so we wanted to highlight a couple of those. I mean, one is that we get involved with a lot is just if a business knows that it needs to do some restructuring for future operations or a future transaction, and there's components of the business that need to come out of the business in a particular restructure, it might be a good time to consider that because the valuations are low and the tax cost of restructuring could be a lot lower right now than it might be in more quote-unquote normal times. Chris, do you want to speak to some of the other items on an individual basis?
Yeah, so when you look at gifting against your lifetime exemption, and I'm using round numbers here, but when you transfer funds from one individual to another, there's a transfer tax, usually called a gift tax. And there are amounts that you can tell the IRS that you've transferred but not owe any gift tax on during your life. And any amounts that have been unused against that limit will reduce the amount of your estate that's subject to the estate tax, which can be really significant. So under the current law, it's a little over $11 million per person is their lifetime exemption for gifting during their lifetime. Any unused amount then reduces the amount of their estate that's subject to estate tax. So if you have a married couple, that's $22 million. Well, one strategy is to transfer ownership in businesses and investments from, for example, a parent to their children, during their lifetime. And if the child is receiving less than a 50% ownership, or the trust is receiving less than a 50% ownership, usually you can apply discounts that reduce the value of the business because the trust or the child doesn't have control over what the business does because they own a minority stake. If you are doing transfers during a low economic point, then valuations will be lower, and the value of what's being transferred for tax purposes is going to be considered lower. So that means you're using up less of this lifetime exemption, and we'll be able to transfer more to your children or to other organizations you want to transfer funds to. So this is very helpful when you're transferring things like portfolio investments, so stocks and other securities. It's also helpful, especially helpful if you're transferring business ownership in closely held businesses. So something to be aware of. Roth conversions are important to keep top of mind. So on the Roth conversion, you pay all the tax on the amount of the distribution now, but then the account will grow tax-free for the rest of your life and will not be subject to the required minimum distribution rules. So that can be very powerful if you're converting at a low point in the market. You're converting at the lowest possible point, at the lowest tax cost for that. You can also harvest capital losses. So oftentimes people think of doing this only when they've sold a business or they've had a large event where they've come into a lot of capital gain income. But it's helpful to look at this at whether or not you think an event like that may happen in the next few years. You could create large capital losses in 2020, and if you think you're going to sell your business in 2021 or 2023, your capital losses, most of which will be unused this year, will carry over and then will be able to be used to offset your capital gain in a future year. So this is simply rebalancing your investment portfolio, selling off investments that have generated losses so you can capture them now. You do have to be careful about what's called the wash sale rules, which means if you sell an investment for a loss and you buy the same investment within 30 days, they disregard the loss. So you'd be selling one equity and investing in a similar equity or something else, or you would sell the equity and wait to repurchase it until after that 30-day period had passed. So those are some of the other tax strategies that people should keep top of mind in a down market. Anything you want to add there, Rob?
Nope, I think that's great.
So with that, we want to discuss some of the other considerations that businesses should be taking a look at during this time. This is a result of a number of conversations we've had with clients and other advisors in the marketplace. And I'm going to cover some of these, and Rob, hopefully you can chime in. But the first one is that during partial closures, especially if you're using payroll protection loans that are incentivizing you to continue to pay your employees even if they're not necessarily in the office or you don't have full patient schedules, one important strategy is what can be done to get the most productivity and utilization from these individuals during the partial closures. So if you have things that need to be reorganized, IT projects that are going to take a lot of organization and training for your folks, now's the time to consider doing those projects to get the most out of them during the downtime. We see a lot of practices limiting their days of operations so they can maintain full schedules on the days that they are open. And for many of our clients, and this is different depending on the specialty, but a lot of the work that's not being performed right now doesn't necessarily go away. It's simply a deferral of when that health care will be received. And so if you think about that, then we would project out in a month or 2 months whenever the economy opens up and people are freer to move around. You would then have a peak demand for deferred consultations and procedures. And offices should be thinking about and prepared to handle that demand, whether it's increased hours, Saturday clinics, whatever it is, to make sure that you can capture that. And this one I'd love your thoughts on, Rob. This is a question that's been asked by a number of different people, and I think it's a very useful question. It's what have we learned from the last situation with so many people working with remotely, so much telemedicine work, so much patient screening before they come in? What have we learned that will change the way we run our businesses when things get back to quote-unquote normal? I don't know what you're hearing on that, Rob, but I'd love your thoughts.
Yeah, I think it's probably one of the blessings in this whole thing is the adaptability that we've all had to live through with working remotely, and I think that will have benefits on businesses for sure going forward. But at the same time, for providers, I do think that kind of going back to some of your earlier comments, I would be getting prepared for a pretty steep demand curve of volumes.
Wonderful. I listed here some things that we heard from various folks. Better utilization of retired physicians, better screening of patients before they come in, increased use of telemedicine. I've heard a lot of people discussing cross-training employees. The concept is having Swiss Army knives instead of single-purpose employees, so folks who can do a lot of different things. And then reevaluating the IT platforms and tools that the practices and the health systems and the clinics have been relying on. So these have all been top-of-mind points of evaluation.
Chris, I would just add, I know we only have a couple minutes left, but I can't emphasize enough the need to, work with your advisors to get through all this, to get through the business implications, but also all the regulatory changes. Your attorneys are a good source of information, certainly CPAs, obviously the bankers as it relates to any of the loan programs, and as it relates to any of the employment matters and benefit matters. I think insurance brokers have been great. We've been working with a lot of different brokerage firms lately, fielding some of these questions. So, in another thing that I think we failed to maybe mention throughout here is, there's certainly provisions here that are specific to taxable entities and taxable taxpayers, but as far as most of the lending and the paid sick and paid leave, that all applies to nonprofit organizations as well. And so I know we've got a lot of tax exempt orgs in this webcast as well.
That's a great point, Rob. And the employee retention credits and the employer payroll tax deferrals will also impact tax exempt organizations as well, because those are payroll tax programs.
And because there was a question that somebody had posted with regards to on the paid sick, paid leave, are healthcare employers exempt from that? I know we've got a lot of healthcare employers here on the phone, and there are some relief exemptions for providers because of what's going on. And I would definitely point you to the Department of Labor, specifically question 56 and 57 on their FAQs on their website. They've got a lot of really great information there.
Great insight there, Rob.
Chris, anything else in the final minute?
We're going to open up to a few. Go ahead.
Nope, go ahead.
With that, we're going to open up to just a few questions. I know we're almost out of time, but maybe we could squeeze one in.
Sure. Let's see. So we did get a lot of questions today. We will not have time to get to every question. However, we will do our best to follow up with you after the webcast. You may also reach out directly to Chris or Rob. Their contact information is here on the screen. And then just wanted to remind everyone about our Moss Adams COVID-19 resources. The links are available in the slide deck and handouts widget. But let's see if we can get to a question here. Will loan forgiveness on the Payroll Protection Program loans be treated? Oops, I lost that there. Sorry, I lost half the question. They'll be treated as taxable income for the IRS. And how about the state?
Yeah, that's a great question, and it's typically a discharge of indebtedness if debt's typically forgiven is a taxable event most of the time, and in this case it will not be. Chris, anything to add?
Yeah, Rob, it won't be for federal. It'll be interesting if that will also apply to the states. I imagine the states will adopt the same thing, but
that's a good point.
Yeah, so some of the states, just so the folks on the call know, conform with the federal Internal Revenue Code on items like this. So some of the states will essentially just update their conformity, and you would expect this to be the same at the state level. Some states, and maybe California, like to be different and frequently do not conform. And so for those states, I think you have to pay very careful attention to that. But even so, it doesn't mean that the Payroll Protection Loan Program isn't a great deal. It still would be an incredible deal, even if it was taxable at the state level on the loan forgiveness.
Thank you. And let's squeeze in one more question here. Okay. Regarding the 90-day filing and payment deferral, how does that apply to 2020 estimated payments normally due 4/15 and 6/15?
Go for it, Chris.
I was about to say the same thing to you, Rob. So the 4/15 deferral, this is one where there was some confusion because there have been a number of different announcements, and some of them were by tweet rather than Department of Treasury formal announcements. But what has happened is the estimated tax payments for 4/15 have been extended to 7/15. The 6/15 payment is still sitting there due on June 15th, as I understand it today, Rob, unless you've seen something updated from that. And there's a fair amount of lobbying still going on with Congress. Congress is still looking at doing another round of stimulus, even though that won't be released quite yet. They're working on it right now, and further changes to when tax deposits and payments are due would likely be part of that proposal. Anything you want to add to that, Rob?
Nope. That's my understanding as well. Is the June 15th payment is still June 15th.
So it never feels funny to pay an estimated payroll tax payment. However, pay your first estimate after your second estimate is certainly unusual.
All right, that is all we have time for now. Thank you so much, Chris and Rob, for a great presentation today. If you still have questions for our presenters, again, you may reach out to them directly. Their contact info is here, and it's also available in our speaker bio widget. And a final reminder to please check out our Moss Adams resources, links available in the slide deck and handouts widget. And here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey, as your feedback is very important to us. And thank you for joining us today, and we hope you'll join us again next time.